All right, hello and welcome to the second flip lesson that we're going to be doing. Today we're going to be talking about economic systems, fiscal policy, and monetary policy. So a short review from what we talked about last week. We talked about economics being a science that describes the factors that determine the production and consumption of goods and services. Putting that in layman's terms, economics is the science of understanding why do we buy things and why do we make things. This is largely dictated by two things: the law of supply, that says as the price for something increases, the quantity produced will increase, and the law of demand, which states that as the price of a good or service increases, the demand or quantity bought of that service will decrease. And so we can see that graphed over here with the supply line going up as price goes up, and the demand line going down as the price goes up. And so in the middle, we have that sweet spot of equilibrium where demand and supply meet perfectly, surplus when there is more supply than demand, and shortage when there is more demand than supply. So that's what we've looked at so far, but what other things affect the economy? So the first thing is economic systems. What economic system does your country employ? And there are three main ones we're going to look at. The first is a market economy. And a market economy is where means of production, things like factories, farmland, resources, the means of production are privately owned. Furthermore, prices and allocations of goods and services are set by supply and demand. So, means of production are owned privately. Prices and allocation of goods are dictated by supply and demand, are dictated by the market. This is a capitalist economy. The USA uses this. Germany uses this. This is also known as the free market. Second is a command economy. A command economy is where the means of production are owned by the government, and the government dictates prices and allocation of goods and services. So in other words, a command economy is where the economy is totally controlled by the government. And we see this in communist countries like North Korea and Cuba. Last is a developing economy, and this is the simplest one. This is an economy that is not fully industrialized yet. And so third world countries tend to be developing economies. Places like Chad in Northern Africa or Ecuador in South America. And so these are the three different types of economies that we're going to focus on. Today, we're going to focus specifically on how things work in a market economy like the United States. How do we affect or tweak our economy? Before we can look at that, we have to look at the concepts of aggregate supply and aggregate demand. These are really simple concepts. Aggregate supply is the total supply of all goods and services within a country. Aggregate demand is the total demand for all goods and services within a country. So rather than looking at a specific company or product, it is everything balled together into one supply line and one demand line. And we graph it and chart it the exact same way. We use it to find equilibrium, surplus, shortage, same thing. It works the exact same way as normal supply and demand. It's just looking at everything all together. Shifts in these two lines demonstrate a change in the economy. And there are two main changes we're going to look at. First is consumers reduce spending. And so if consumers reduce spending rapidly, this entire demand line will shift to the left, meaning essentially that now prices need to be even lower to convince more consumers to buy something. So a fall in aggregate demand, which leads to a reduction in output or production and prices. Fewer people are buying things, so you need to make less, as well as people are now not willing to pay as much for your product, so you need to reduce prices. When this happens, this can lead to a possible recession, and a recession is a temporary decline in the economy. So a temporary decline in the economy. And so in 2008, when the economy crashed, that was a recession. The second problem we can see is too much money or consumers spending too much. So we can actually have a problem where consumers are spending too much money too quickly. And so we see then a large increase in aggregate demand. So now this entire line shifts to the right. More products are being demanded and people are willing to pay more money for them. This leads to a rapid increase in output/production. Now, the problem with this is that this can lead to serious inflation. Inflation is, excuse me, inflation is when the currency of your country, the value of a country's currency declines. So basically, your currency is worth less than it was before. This can happen through things like too much money being injected in the economy. People aren't saving or putting their money away. They're putting way more money into the economy than there was before. Or this can happen when you print more money. And we'll talk about those things in class. So how do we prevent these things from happening? Well, there's a sweet spot in the economy to make sure these things don't happen, but the economy still grows. So it doesn't decline, but it also doesn't grow too quickly. And so this sweet spot involves three things. First, an annual GDP growth of 2 to 3%. So an annual GDP growth of 2 to 3%. GDP is gross domestic product, and that is the total value of all goods and services within a country. So it's taking everything in your country, putting it all together, and saying this is how much that all is worth. And so every year you want to see that number grow 2.5 to 3%. Annual inflation, you only want to see that increase around 3 to 4%, and you want an unemployment rate around 5%. So this is the sweet spot for perfect economic growth. So how do we keep aggregate supply and demand from skewing too far up or down while staying in that sweet spot that leads to constant economic growth? Well, in a place like the United States, we do that by using something called fiscal policy and monetary policy. So fiscal policy is the use of government spending and taxes to stabilize the economy. Monetary policy is the use of the money supply and credit to stabilize the economy. And we'll look at more of what those mean here in a second. So the history of using these two things, back in the 1920s and 30s when the Great Depression started, we used classic economic theory to solve this problem. And classic economic theory essentially said, don't do anything. Let the economy fix itself. The result of using classic economic theory was the worst economic crash in U.S. history. And so a guy named John Maynard Keynes suggested or came up with the idea of using fiscal and monetary policy. So if you ever hear the term Keynesian economics, this is what it's referring to, is using these two things. So how do we use fiscal policy or taxes and government spending to fix economic issues? Well, first let's talk about a recession or a drop in aggregate demand. First, we increase government spending. Why do we do that? It pumps money into the economy. It gives producers more money to produce things. We decrease taxes. Why do we do this? It gives the average consumer more money to spend. The result is that now more people are spending money, and now businesses have more money to create more products. And so this leads to a rise in aggregate demand. Aggregate demand goes back up because more goods are being produced and more money is being spent as you're not paying as much in taxes. Against inflation, we do the opposite. We decrease government spending. So we give less money to producers, to firms. And we increase taxes. This means that people will have less money to spend. So now the result is businesses have less money to produce things. Consumers have less money to spend. And so aggregate demand falls back down. Now let's look at monetary policy. And we're going to start that by looking at the money market. Similar to there being supply and demand for any product, there is supply and demand for money. Consumers want money or demand money because they want to take out loans for things like cars and homes. Firms or companies or producers demand money because they want to take out loans for things like factories or equipment. So that is what dictates the demand for money. The supply for money is dictated by something called the Federal Reserve. What are they? Well, the Federal Reserve is the central bank of the United States. What do? They dictate the money supply, or in other words, they print more money, and they set interest rates. Interest being, say you borrow $1,000 at 10% interest. That means when you pay that loan back, you have to pay $1,000 plus 10% of that $1,000. So the Federal Reserve prints money as well as set interest rates. And so this altogether is the money market. We look at these two things to determine the interest rate that must be paid on borrowed money. An increase in the supply of money, so as demand increases, supply will increase. An increase in the supply of money equals a decrease in interest rates, and a decrease in the supply of money equals an increase in interest rates. So how do we solve economic issues using monetary policy? So first, let's look at recessions, and there's actually 3 different ways the Federal Reserve can use monetary policy to solve recessions. The first is increase the money supply and decrease interest rates. Why do we want to do that? Well, we want to increase the money supply so there is more money to loan out for people to spend. And we want to decrease interest rates because that will incentivize people to borrow more money. If I am only paying like 0.5% interest on a loan rather than 2%, it's way more likely that I'm going to take out that loan. The result is an increase in aggregate demand due to more money being borrowed. I'm borrowing money, which means that I have more money to spend, which means there is an increase in demand. Another way would be through decreasing something called the discount rate. And the discount rate is the interest rate that banks pay on the money they borrow. And so it's a similar concept to this, but for smaller banks. So the result is banks are willing to borrow more money. They will then loan out that money to their customers at a lower interest rate, which again means more money is loaned out, more money in the hands of consumers. Aggregate demand will increase as people have more money. So these are the first 2 ways to deal with recession using monetary policy. Lastly, and only in times of serious recession, is a reduction in the reserve requirement on banks. The reserve requirement is the minimum amount of money a bank must have in its vaults at one time. So, this is the minimum amount of money the bank must have on hand. They cannot go below this threshold. They have to make sure they have this much money in their vaults so that they are able to give people the money in their accounts. The result, similar to this one over here, is now the banks have more money to loan out. They'll loan them out at lower interest rates. That's more money loaned to consumers. They will spend that money, which lowers aggregate demand. Again, as you should see, the recurring theme with fighting recession is increasing aggregate demand. I think I just said here for the reserve requirement, decrease aggregate demand. That will increase aggregate demand. You want people buying more in a recession, spending more money. Lastly, they really only have one thing. The Federal Reserve only has one thing it does against inflation: decrease the money supply and increase interest rates. And so you increase interest rates to get people to take out fewer loans, which means they're not going to spend as much money. The way this decreases the money supply is that now people will put more money into savings rather than spend it. They can't take out as many loans, which means they have to rely just on their income. So more of their income is going to go into savings. So the result is people will borrow less, which means they will spend less, which means aggregate demand will decrease. So that is all on economic systems, fiscal policy, and monetary policy. I know that was a lot. We're going to spend about 3 to 4 days going over this in class because, again, this is a lot. This is confusing. But don't worry, we will get through it. If you have any questions, let me know. Be sure you take the Schoology quiz over this and have a good one.